In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about an update on inflation numbers in India, and we'll also understand why these numbers and this data overall is important for you and me as investors and for people who track the markets. And in the second story of the day, I'll talk about the US Federal Reserve and the rate cuts and what they really imply for the rest of the world, including people like you and me. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 15th of January. Let's begin with the first story. See, recently the latest data for India's inflation was released, and it is very important for us as people who track the markets to know exactly what is going on. See, after many months of concern over rising prices, India's retail inflation, which by the way is measured by the Consumer Price Index, has cooled off in the month of December 2024. It reached a 4-month low of 5.2%. Now this matters because inflation directly affects our cost of living. For families, businesses and policymakers, inflation in general brings both relief and some challenges as well. Now, over the past few months or so, inflation has been on a downward trend, so to speak. It peaked in October 2024 at 6.2%, but ever since then, it has dropped to 5.5% in the month of November, and now December's 5.2% is the lowest in the last 4 odd months. Now, this decline is largely due to easing food prices, which have been one of the biggest drivers of inflation in our country overall. Now, the thing with food prices is that they can be very volatile because they very heavily depend on things like weather, crop yields, and global market conditions. Now, in December, food inflation fell to 7.69% from 8.2% in the month of November, which for sure is a clear sign of improvement. Now, this drop was helped by a significant reduction in vegetable prices, especially for staples like onions, potatoes, and tomatoes. Now, these items, for your context, usually make up a large part of the average Indian household's diet. So whenever their prices come down, it provides immediate relief for people like you and me. For instance, vegetable inflation dropped to 26.6% in the month of December, which is the lowest in 4 months. But that said, all of this does not mean that all food prices have fallen down. Edible oils, for example, saw their prices shoot up by 14.6%, which is the highest in 32 months, and this was due to factors like import tariffs and global shortages. And on the other hand, items like milk and meat also became more expensive over time. Now, while food prices dominate headlines overall, there is one more part of inflation that is called the core inflation, which is also worth paying attention to. See, core inflation excludes food and fuel because they are more volatile in nature and they can distort the overall picture. Now, in the month of December, core inflation remained steady at 3.6%. And this is good news because it shows that the prices of other goods and services like education, healthcare, and transport are not rising as quickly as they were. In fact, core inflation has stayed below 4% for over a year now, which signals stability in the economy as a whole. Also, according to CareEdge ratings, the outlook for agriculture remains to be positive. It is supported by a robust Kharif production season and favorable conditions for Rabi sowing due to a healthy reservoir level. Now, Rabi sowing is up 0.5% year on year as of December end, which also indicates some strong progress. Now, all of this should effectively ease up food inflation a little further. Now, on the wholesale front, India's wholesale price index, or the WPI, which is by the way a measure of inflation at the producer level, rose slightly to 2.37% in the month of December from 1.89% in the month of November. This increase was driven by higher food costs for food items and for textiles. But on a month-to-month basis, the WPI actually fell by 0.38%, which indicates some softening in manufacturing costs and primary articles like crude oil. Now, the Reserve Bank of India is likely watching these numbers very closely. In the recent Monetary Policy Committee meeting, the policy repo rate was kept unchanged at 6.5%. Most members, including former Governor Shaktikanta Das, supported this decision and cited the need to balance inflation management with supporting growth of the nation. But Dr. Nagesh Kumar and Professor Ram Singh voted for a 25 basis point rate cut, and they argued that it could help revive economic activity without quite significantly worsening inflation in the country. Now, in December, the RBI projected headline inflation to average 4.8% for the quarter, and the actual figures actually ended up aligning with these expectations. And this has ended up reigniting some discussions on whether or not the central bank will cut interest rates in Feb 2025 in order to support economic growth. Now, lower interest rates make borrowing cheaper, obviously, which eventually encourages businesses to invest and consumers to spend, which can overall boost our economy. But the RBI will also be very cautious because inflation, while it is cooling for sure, is not yet fully under control. More so, especially considering there are global uncertainties like fluctuating oil prices and a weakening rupee as well. Also, imported inflation is another factor that adds to the complexity here. In December, imported inflation rose to 5.4%, which is the highest in the last 22 months. Now, the rupee has weakened by about 4% against the dollar ever since the start of the financial year, which makes imported goods more expensive as a whole. Now, this could limit how much the RBI can reduce interest rates in the near future. Now, finally, there is also the new RBI governor at the helm now. So, it'll be very interesting to see how he manages to balance the need for rate cuts to support growth against the imperative of keeping inflation under control. So, in summary, the drop in inflation is great news on the surface, especially for households that are struggling with high food prices. But it is still a mixed bag, so to speak. While vegetables are cheaper, items like milk, oil, and proteins remain more expensive. Core inflation is steady, which indicates stability, but imported inflation is rising, which is adding to long-term risks. According to India Data Hub, inflation remains to be a hurdle for rate cuts for the RBI. While headline CPI has moderated, like I mentioned, the pace of decline has not been sharp enough for them. And the persistent depreciation of the rupee adds one more big challenge here. Globally speaking also, monetary easing is on a pause, with Fed fund futures showing less than 50% chances of a US Fed rate cut even by March. So it's probably safe to assume that it seems very likely that RBI will maintain a status quo in the February policy meeting. And that, ladies and gentlemen, is a great segue to move to our second story of the day. See, since September 2024, the US Federal Reserve has reduced interest rates by 1%. Now, typically, whenever the Fed cuts interest rates, long-term bond yields like the 10-year Treasury bond yields tend to fall. But this time around, the 10-year bond yield has actually risen by 1.15%. And at the exact same time, the US dollar has become stronger and has reached its highest value since 1985 when adjusted for inflation. Now, this particular combination of events is very unusual, and it is not something that we often see happening together. And to understand exactly why this is unusual and why it matters to someone like you or me, let's take a look at what typically occurs when the Fed cuts interest rates in the first place. See, lower interest rates are meant to encourage people and businesses to spend more and borrow more cheaply. Now, ideally speaking, this should bring down bond yields further along the curve, such as the 10-year Treasury bond, because investors usually expect easier financial conditions to keep yields low. But right now, the exact opposite is happening, as I said. It's almost as though we are watching an entirely new rulebook unfold in the year 2025. Many analysts are now talking about something as the term premium in order to explain this. See, term premium in a very simple language is the extra return that investors want if they are going to lock up their money in long-term bonds rather than keep rolling over short-term bonds. Now, recently, this term premium moved from negative to around 50 basis points, which is quite a big swing. And the tricky part here is that people define term premium very differently. So experts sometimes talk past each other even though they use the same phrase altogether. Also, if you look at history a little bit, the closest example to what is happening right now took place back in 1981. Now, back then, the Fed lowered interest rates from about 20% in May, and to everyone's surprise, the 10-year yield jumped from 12% to nearly 16%. And that is when the concept of bond market vigilance took center stage, which basically refers to traders who very sharply reacted to inflation fears and policy decisions by selling off bonds, which then pushed yields higher. So in a way, the market itself forced policymakers to take notice. Now currently, the Wall Street is worried where the 10-year Treasury yield will head next. Some investors say that a 5% yield on the 10-year might be a breaking point for the stock markets. If yields rise that high and just stay there, the argument goes that markets might adjust. But if yields shoot past 5%, it could cause more volatility and possibly a bigger sell-off in stocks. Meanwhile, the analysts at Charles Schwab note that over the last 5 decades or so, the 10-year bond yield has usually hovered around 120 basis points above the Fed's short-term interest rate. But since 2010, the difference has been closer to 125 to 150 basis points. Now with the Fed funds rate at 4.5%, a fair 10-year bond might land around 4.5% to 4.75%. If you think about it, we are already in that neighborhood now. Now, another topic people are watching very closely here is inflation expectations. Research from Jim Banco suggests that when the Fed was raising rates in 2022 and 2023, inflation expectations actually fell down. Then, when the Fed stopped raising rates, those expectations remained to be steady. But now that the Fed has begun cutting rates, inflation expectations have actually picked up again. Back in 2008, inflation expectations had spiked when oil was at $145 a barrel. Today, oil is around 80 US dollars, and yet inflation expectations are still on the rise. So, this shows you just how concerned investors in general are. But beyond the US, also, there are big global consequences for this. A stronger US dollar plus higher treasury yields means investors are more drawn towards US assets, and as a result of that, they pull money away from other parts of the world. Brazil, for example, has already raised its interest rates again and has spent around 30 billion US dollars of its foreign exchange reserves to protect its currency. The biggest fight though is China, where the People's Bank of China is working very hard to stop the yuan from weakening beyond about 7.32 to 7.34 against the US dollar. Across Asia, countries like South Korea, India, and Indonesia are facing added stress as well. India's rupee was quite stable during 2023-2024, but it has started to weaken right now. Some people believe that the new RBI governor may not be as quick to intervene in the foreign exchange market as the previous governor was, which could let the rupee move even more freely. For the rest of this year, Schwab thinks that the 10-year yield might climb closer to 5% if inflation gradually continues to cool and the Fed cuts rates by another 50 basis points or so. Now, this forecast, of course, assumes that there are no major policy shocks. But the thing is, Donald Trump's admin has been known to make sudden tariff or immigration policy moves, and there is also an ongoing debate about government spending. So, any of these could change the situation in a very short time. At the Fed's December meeting, officials hinted at two possible rate cuts in the year 2025, and this could bring the Fed's fund rate down to around 4%. Now, markets initially priced in faster or bigger cuts, but a strong jobs report in December changed all of those expectations. Investors have since then become less certain about how quickly or how deeply the Fed might cut interest rates in the months to go ahead. In the meantime, money is being drawn to the US because investors can earn almost 5% from treasuries while also enjoying possible gains from a stronger US dollar. So, if you think about it, when you can get a relatively high return in arguably one of the safest markets of the world, you will have to think very carefully before you invest in other and more riskier places. And that is why many emerging markets are now starting to feel the pinch. And this also explains why so many global central banks are intervening in their own currencies or tightening their policies further. So if you think about it, it is a very delicate balance that we are in right now. No one wants to see a downward spiral in their own currency, but they also need to be very mindful of slower growth and weaker economic indications. And that's where things stand today. Also, right now, almost everyone is just trying to figure out just how long these unexpected moves will last and what they will mean for the global economy in the many more months to come. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, HCL Tech reported a net profit of 4,591 crore rupees in the third quarter of FY 2025. This represents a 5.5% increase as compared to the same period last year and an 8.4% rise as compared to the previous quarter. The company's total revenue for the quarter reached 29,890 crores, which is 5% higher than last year and 3.5% higher than the previous quarter. Second, China posted a record trade surplus of 992 billion US dollars in 2024, which is an increase of 21% from the previous year. Now, this was largely driven by strong exports, including a $525 billion worth of goods shipped to the United States. Just in December alone, exports to the US had hit 49 billion US dollars, which is the highest figure in more than 2 years. Even though global demand has been solid, China's imports have been held back a little bit by weaker domestic spending and lower commodity prices. Third and the final one for the day, Urban Company, which was in 2021 valued at 2.1 billion US dollars, is now planning to file an IPO worth about 3,000 crore rupees. They plan to file this by March 2025. Now, this IPO will be led by Kotak Mahindra Capital, Goldman Sachs, and Morgan Stanley. Urban Company currently operates in about 50 Indian cities as well as in UAE and Singapore, and they offer a range of services like beauty treatments and appliance repairs. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. As usual, I will see you in the next episode. This is your host Anurag Bansal signing off. Take care and goodbye.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.